Good morning, and welcome to our webinar, Americans Doing Business in Canada. My name is Stephen Flynn. I'm a partner with Andersen here in Vancouver.
Good morning, everybody. My name is Krista Rabidoux. I'm a partner here with Andersen, and I'm usually located in our Calgary location.
And we would have been joined today by Jonathan Garbett from our Calgary office. Unfortunately, he couldn't make it this morning, so Krista's graciously agreed to step in and help us out. We appreciate all of Jonathan's work here on the background, putting the slides together, and we know he's with us in spirit today, so thank you. We're going to cover a number of topics, both corporate, personal, sales tax, and other withholding tax regarding with respect to our topic, which is Americans Doing Business in Canada. We want to thank you for joining us today. We're probably going to spend about 45 minutes this morning on the presentation and the formal portion. We have left time, as we usually do, for questions. So if you have questions, you should see a Q&A box there on your panel, on your screen. Please type in your questions, and we will do our best to get some answers to you. So without delaying any further, if you just want to go back 1 second here, I just might lose my apologies there. So this is a list of some of the topics we're going to cover this morning in our presentation. We'll start off going through the tax rates between the two countries. We'll then focus in on some of the corporate tax issues that we've got. We'll talk about some of the personal tax issues with respect to working between going from the U.S. to Canada. We'll then also cover things in addition to income taxes. We'll talk a bit about Canadian sales taxes, both at the federal and provincial level. And then we'll talk about some of the withholding taxes that go through as a project or as an assignment is going. So that's a bit of a laundry list of what we want to cover today. Next slide, please. Thank you. So just to kind of give a framework here, and if you've joined us on our presentations in the past, you've probably seen this slide, but I think it's an important one. When you're going northbound, when you're an American business, an American entrepreneur who wants to come and do work in Canada, to say, well, what are the income tax rates between the two countries? What am I looking at going forward? And so if you look from a domestic or a U.S. point of view, if you look corporately, our federal income tax rate, it's a flat rate right now at 21%. To that, we're going to add state income taxes. And state income taxes can be anywhere from 0% for an income tax if you're in places, you can get nexus in places such as Washington State, Nexus, and there's probably a dozen different states that have no state income tax at all. On the other hand, if you're in more expensive states like a New York or a California, your corporate tax rate could be as high as 8 to 10%. So we're using an average rate of 5% to do a bit of a comparison to say your total combined U.S. corporate tax rate is about 26%. Your Canadian corporate tax rate, if there's a permanent establishment in Canada, we'll talk a bit more of that, is approximately 27%. And that'll vary based on whatever province you're doing business in. For example, in British Columbia, if you're an American business and coming to do business in Canada and subject to income tax here, your combined federal and provincial income tax rate is about 27%, fairly similar to what you're paying in the U.S. right now. There may be some changes going forward. You can see on the far right-hand side here, under the President Biden's proposals that are going through Congress, going through the Senate right now, he's proposing to increase the basic federal corporate income tax rate to as high as 28%. And when you add state tax on top of that, that could get the total combined rate in the U.S. to 33%. That would be higher than Canada. That's what we used to see years before the Trump tax changes, when the federal corporate tax rate was 35%, and Canada was a bit of a tax haven compared to that. And there's a lot of kind of changes back and forth. I know in your province,
Alberta, yes.
Alberta.
We are the tax haven.
Right. So the corporate tax rate
10%.
is 10%. So your combined rate can get as low as about 22 to 24%.
Yeah, exactly.
So much lower.
Yeah.
On the personal side, it's always important to say, well, it's one thing for business to be working here in Canada, but we're going to send people to Canada. We may have entrepreneurs that are coming here temporarily or permanently. What are the tax rates and the comparison between the two? And so if you look at the personal rate from the U.S. perspective, If we take the top marginal federal tax rate of 37%, plus something called net investment income tax, we've abbreviated here as the NIT for short, that's the Obamacare levy of 3.8% that applies to interest and dividends and capital gains at certain income thresholds. It's important to consider that because that may be levied on profits that are coming from Canada back to the United States. Your top rate's 41% combined. If you added an average state tax rate of 6%, you're close to 47%. Now, in contrast, Canadian personal tax rates tend to be a bit higher. Our personal tax rates can be as high as 54% in British Columbia. They can be even higher in Ontario, and they kick in sooner. Your top marginal tax rate personally in Canada starts at about $220,000 to $225,000, whereas in the U.S., depending on your marital status, it could be as high as $500,000 or more before that top marginal rate kicks in. So there's a bit of a discrepancy there in the rates.
And so what do you think the likelihood that this Biden's going to come through? Do you think it's likely?
Well, I think it's a great question, Krista. The idea here that the proposals these tax rates are being proposed both federally and, both corporately and personally. There's a lot of work to do in the Senate.
Yeah.
As much as the Democrats have this 50 seats there plus the vice president vote, there's still a lot of moderate Democrats that may not be convinced that increasing tax rates is the right way to go. There's a lot of work still to do. When you kind of look at the summer going by quickly and all of a sudden we're a year away from midterm elections, the window's starting to get a little narrow. So it's there. Tax rates may go up. It remains the same.
Exactly. Okay. Yeah, for sure.
Sure. Next slide.
So going back to the rates in Canada, sometimes when you go to a country, you don't necessarily have a choice of whether or not you get to pay tax, and you do your best to try and minimize the tax rates. But there is rules in Canada when you're doing business in Canada, when you're subjected to tax. Now, there's different thresholds. So if a company's coming here, or an individual is a sole proprietor for that matter, coming to Canada to do business, and they're coming from a non-treaty country, you're going to be using the domestic law of Canada, which is basically, you're here, you're doing business, you're subject to tax and the income tax. So it's pretty low threshold when you're looking at the domestic law as to whether or not a business would be subjected to income taxation. Now, when you're looking at, whether or not you're subject to tax and you're coming from a treaty country, as we're talking about here, Americans doing business in Canada, Canada and the U.S. have a treaty. So you then get to use that to protect some of the profits that you're earning in Canada from taxation. I'll go into that a little bit further in the next slide. But for now, it does exist. It's there. It's something that helps to limit the exposure. And I will say, even if you do have treaty protection, you're still required to file a corporate tax return. So even though your income and profits your taxable income is not subject to income tax in Canada, you still need to file that disclosure return reporting to Canada that you're taking a treaty protection to not pay tax. Income tax, right? And that doesn't protect you from sales tax. It doesn't protect you from payroll tax necessarily. We're just talking about business income tax for the permanent establishment.
Well, that's right. And it sometimes catches American companies that come here that say, okay, well, I don't really have a Canadian corporation. I'm just doing business here. I don't have a process. I get into details.
Yeah.
Why am I required to file a tax return? Well, one of the consequences of not filing a tax return, it's a small penalty, but while our penalties are generally calculated on the basis of whatever amount of tax is owed, for an American company that's coming to Canada that has to file a return that doesn't do that on an annual basis, that penalty can be as high as $2,500 per year for every year it's not filed. Filing a return also starts the statute of limitations.
That's right.
So that
protection.
If there is some debate whether you should or shouldn't be subject to income tax in Canada, you can at least start the clock by filing tax. That's important.
Yeah. And with respect to federal and provincial tax, so in the U.S., you're quite used to filing a federal return and potentially 20 state returns. Canada has a little bit different of a model in which we only have a couple of provinces that require you to separately report your business income from the federal return. Most of the provinces are included right within your federal return, and you do a multi-jurisdictional allocation with payroll and revenue as to which province gets which tax.
So some
included.
similarities.
It's similarities,
the U.S.
yeah.
looks at it with an allocation.
That's right.
Canada looks at some of the same factors.
Exactly. The biggest difference is most of the provinces are embedded right in that one return for the federal.
Absolutely.
And so looking more at what is a permanent establishment, how do you determine whether or not you have that permanent establishment? And looking at a fixed place of business in Canada, you're looking at things, do I have an office? Is there a place of management? Do I have a factory? Those types of things generally would create a permanent establishment in Canada if you have that fixed place in Canada available to you. There is a bit of a mixed conception on what is a fixed place in Canada, because some people say, well, I just use an office in this building and it's one office. And technically under the rule, just having a single office available to you at all times is a fixed place of business in Canada. And it's there for you. It's available for use. You have a business card with that address on it. You have letterhead with that address. You've created this base in Canada. And Canada will generally view that as a fixed place of business, regardless if you're only using it a little bit of the year. It's still a place of business. So you need to be really careful when you're creating marketing materials and you're creating that type of stuff, because you inherently could create
you could be representing the fixed place of business.
That's right.
Even though your intention say, well, no, I'm never going to cross the border.
That's right. Yeah.
And that happens from time to time when we advise clients on these things. We always want to talk about what's the circumstance now.
Exactly.
And the plans may be, well, we're not really going to do much physically in Canada yet. We're still kind of feeling our business out. But in time, we may hire some people. We may have a business. We may have a place of location. We may have, some sort of physical presence.
Yeah. And that's exactly it. So it's a planning, right? And we always tell people you want to look ahead to what is your intent in the future,
right,
and create the path as you see it, because it's a lot easier than trying to fix it after the fact, right?
So what may not be a permanent establishment now may be created with further actions in a couple of years.
That's exactly
it. Subject to protect you.
Yeah. And the other area is having someone here as an agent, and they're dependent on you. So it could be a contractor, it could be an employee. It doesn't necessarily have to be an employee per se. But if they're a dependent agent and they are signing sales contracts with customers, if they are concluding contracts in Canada, that can create a permanent establishment. So a lot of the times we tell people, you know what, they can promote you, they can advertise you, they can be a salesperson, but they should not be signing any contracts for you in Canada if you do not intend to create an establishment here. Because there's a bright line test.
I think you're right. And I think a lot of that is created on what is the business going to entail down the road. And people will say, well, as an owner, and I live in the U.S. and I want to start something in Canada, I'm going to be here a little bit, I'm going to have some people here, but I'm in control of this. I'm going to do all my credit checks, I'm going to do all my pricing, I'm going to do all my contracts to be signed when I'm back in my office, and that's fine. Mm-hmm. But then when you ask that next question, say, well, where do you envision the business being down the road? And they say, well, I can't do this forever. I want to be able to replicate this in Canada, so I want to be able to hire someone who can basically, take over and run the business. And whenever I hear that phrase, run the business,
that's right,
that tells me that person is going to be a senior level. They're going to be making decisions in Canada. They're going to be signing contracts. Mm-hmm. They're going to create that firm establishment at some point down the road. Exactly.
And so when you have that, and to be clear, creating a firm establishment is not necessarily the end of the world. It's just, it's now you have to pay tax. There's the treaty between Canada and the U.S. There's foreign tax credits, so it doesn't necessarily create that double taxation, but it's just, you need to be aware that you're going to now have some transfer pricing. You're now going to have some income tax in Canada. You have other considerations you need to think about if you've created a permanent establishment. So it's not necessarily the end of the world. And the other thing is providing services in Canada. And a lot of the time when we're dealing with clients, they think in their fiscal year or they think in the calendar year. And the services in Canada is actually any 12-month period. So you could have someone here from October to June. And that could create a permanent establishment if they're providing services on your behalf, on the business's behalf in Canada. And it's over a 12-month period, and it doesn't have to be consecutive. It doesn't have to be.
And it doesn't have to involve an office or a place.
No, it purely
is just someone physically present in Canada.
You could be going to a site and working on a site and helping on the site as you have your employees or whoever it might be coming up to provide those services for 6 months, that could create a permanent establishment.
So someone who does that 2 weeks on, 2 weeks off type project is
Yeah.
really close to that line if you're here over a 12-month period. You
Exactly.
start to count the days, you
Yeah.
start to count the work days, the travel days, and say, well, how close are we to be creating a permanent establishment? Even though we don't have an office, even though we don't have a fixed place here,
Yeah.
that activity may create one for that period of time.
Exactly. So it's similar to the residency of an individual. Permanent establishments is you kind of got to go through the layers and peel that onion and figure out, am I caught by any of these things? Because they're all ors. It's not ands. You don't need to have all of them. It's one or the other and you're caught. And then with respect to natural resources construction, I know you guys have that a bit more in BC with the mining industry and so forth. And in Alberta, we have the oil industry where we have companies coming up to Canada quite a bit for construction. You want to be looking at how long are you present? Are you present in that site for 12 months? And if you are, you're likely going to create a permanent establishment. So,
It's long-term installation,
That's right.
construction, or other contracts. And one of the ones we see quite often is when American companies come to Canada and are doing a big software installation. And it's you'd love to think those things can be done in a couple of months, but all of a sudden it's a big assignment and it goes on, and now it's kind of a 2-year
That's right.
contract. Now you got to be looking at whether that creates a permanent establishment.
Yeah. And, you know, the interesting thing about permanent establishment, and we've been seeing it more so, is the digital world. And how do you get a permanent establishment in the digital world? And there has been commentary coming out from CRA on, you know, if the servers are in Canada, maybe you're creating a permanent establishment in Canada. It doesn't always need to physically be that person that's there, right? So it's just things, and the whole digital world is so new, so there's not too much guidance on it yet, but it's just knowing that that risk could be there. Yeah.
So one of the things that we talk to our clients a lot about when they come to Canada is what type of entity they want to use here and what purposes are going to derive. And so there's a number of different choices that companies can make. They can start out to say, well, maybe we don't want to do anything right here. We'll just continue to use our U.S. business, which could be anything from a regular corporation to a limited liability company to a partnership to even a self-proprietor, to say, I'm just going to work up here. I'm going to call that a branch. So there's no formal entity here. It can have some advantages in the sense that if it's a U.S. entity and if it's a branch in Canada, and if we haven't established a permanent establishment here, then in general terms, the activity that's done for the Canadian activity or even in Canada would not be subject to Canadian corporate income tax. That can have the advantages of simplicity if it's a short-term assignment. If it's something that doesn't have a long time permanence or long time kind of growth potential here, that it's kind of a one-off, that can make a lot of sense. Mm-hmm. Other alternatives, including the use of a Canadian corporation, and unlike the U.S., where there's kind of a whole laundry list of different types of entities you can choose, Canada is a little more limited when it comes to corporations. We have something called a regular Canadian corporation and something called an unlimited liability company or an unlimited liability corporation, if you will. So we'll talk a bit about those two. You know, in general terms, that gets you back to those corporate income tax rates. So once you establish a Canadian corporation, you now have an entity that's a resident of Canada. It has a permanent establishment in Canada, so the profits that are associated with that Canadian corporation would be subject to Canadian income tax. Mm-hmm. That can have some merit and some value when there's maybe a longer term approach to Canada, mm-hmm. that we want to be here, we want to try to build something for long term. As we'll talk a little bit further, that can have some advantages for goods and services taxes, or GST or HST in Canada, have a Canadian corporation here. For a lot of American businesses, though, they kind of want the best of both. They want to be able to have as low tax rates as we can achieve here, but have, you know, a flow-through activity that we similarly see in the U.S. with limited liability companies and S corporations and partnerships. And one thing we have in Canada that has a lot of merit is something called a Canadian unlimited liability company. It's been around for 100 years or more in Nova Scotia. It's been enacted recently over the last 20 years in Alberta and British Columbia. And the idea is that it's a Canadian corporation. It has the same attributes that a regular corporation does from a tax perspective. Its biggest difference is from a legal perspective, the shareholders have an unlimited liability.
That's right.
That doesn't sound attractive.
Well, I mean, for certain professions, you certainly don't want to have no protection
Absolutely.
from the activities of the business, right? Like if you're looking at someone who's going to be mining, and if you come across something and you have no liability protection, it could be quite disastrous.
And it can be a bit of a scary phrase to hear. Assuming that can be solved from a legal perspective, which it generally can be by the use of holding companies in the U.S., it has the advantage from a U.S. income tax perspective in that, unlike a corporation in Canada, an unlimited liability company is considered a disregarded entity if it's completely owned by someone, or a partnership or a flow-through entity. And so whatever happens within the unlimited liability company, it's as if it's a branch for U.S. tax purposes. So if there's losses in the first startup years, those losses would be trapped in a Canadian corporation, but they get to flow through to the owners of an unlimited liability company.
Yeah.
If it pays tax, for example.
Yeah, exactly. In Canada, it would file as a regular corporation. Yeah. And it's a great way to flow foreign tax credits quickly, especially with all of the new rules under the U.S. law, the GILTI inclusions and Subpart F inclusion. It creates an easier mechanism to create the timing. So you're not always trying to worry about when do dividends need to be paid and stuff. Absolutely. Because from the U.S., it's all available to
Absolutely.
you.
It's a great vehicle if you're able to flow through that corporate tax, which we talked about, to claim as a foreign tax credit on a U.S. tax return to avoid double taxation. One of the other unique advantages, and we see this from time to time, I've got two clients in this situation who have a partner here in Canada, and they'll come up and do a joint venture, just do something where it's the U.S. partner will own 50% of the entity, and the Canadian partner will own 50% of the entity. And what it creates under Canadian law is an advantage to lower Canadian taxes even further. So if a company in Canada meets the test of something being called a Canadian-controlled private company, with corporation, which in general terms means that it's controlled either by fact or just by nature, by law, by a Canadian resident or a series of paying residents, then the first $500,000 of profit each year are actually taxed not at 27%, as we talked about before, but effectively at a combined federal and provincial tax rate of anywhere from kind of 10 to 12%. So a much lower tax rate. And it's an incentive for small businesses. It's got to be a private company. It's got to be controlled by a Canadian group of entrepreneurs or Canadian residents, if you will. But by having a 50-50 ownership, that will meet the test. And so what that does is, in situations where U.S. owners may not be at the top marginal tax rate, because foreign tax credits in the U.S. are calculated at an average tax rate. What we find since the Trump tax changes is that a lot of entrepreneurs are making maybe $200,000, $300,000, $400,000 a year. Their average federal tax liability, with all the deductions and everything else, is only about 20% or 22%.
Yeah.
Well, if we're paying 27% in Canada tax, we can't get a full dollar for dollar credit. But if the first $500,000 is only taxed at 11, and we do the math, and the average tax rate in Canada gets some sort of blended 20 to 22% rate, then we do get a full dollar.
That's right.
Credit.
Yeah.
And it can be a real advantage, especially in some of those startup years where you're trying to leave as much capital behind in the Canadian company to grow. So a lot of different choices on what entity to use. I'd say there's no one best answer on what to use. It really depends on the facts and circumstances. And there'll be some more details there as we talk about that may help you make that decision.
Right. Yeah.
We've talked a lot about corporate tax.
We have.
And it'd be remiss not to talk about some personal tax issues, because oftentimes people will come up and work here. They'll come up and work here. They'll either send their employees up here. They'll have some contractors up here. People will be physically working in Canada. And what's important from a Canadian personal tax perspective is where are they conducting the services. It's one thing to have a contract to work for a Canadian company, but if you're providing all the services in the United States, in general terms, the individuals wouldn't be subject to tax in Canada because they're not physically working here. However, once they start physically coming to Canada and spending time here, whether it's temporarily in Canada or particularly if they move here, then they're going to be subject to Canadian personal income tax. Now, the tax treaty between the countries gives us some grace, and there are some exceptions to this. So, for example, if you go back to my first scenario, where it was a branch or a U.S. company that was working in Canada but didn't have a permanent establishment, if the individuals come to Canada and work here in that same scenario, and if they spend less than 183 days in Canada, because they're not working for a permanent establishment in Canada, even though they're spending time here, in the end, they're not subject to Canadian personal income tax.
So Steve, we talked a bit about on the corporate side that a corporation is still required to file a treaty-based corporate return, or it's a $2,500 penalty. Is there anything similar on the Canadian or the individual side?
Well, to get to that answer, yes, there is. And so what ends up happening is that there's an obligation both for the payor to withhold tax and for the recipient, the individual, to file an income tax return to get to that result. And we'll talk a little bit that in some detail, what that might mean and what some of the procedures are. To the extent, though, that and the other exemption I want to talk about a bit is on the tax treaty is there's a de minimis rule too. If an individual is working for a firm established in Canada, but if they're only here for a couple of weeks, a year, and they make less than $10,000, then again, they're not subject to income tax in Canada.
You know, it's interesting because we're in an era right now of the remote work site, and we're seeing it more and more that even though you have an individual who works for a U.S. company, is not providing services to a Canadian business, they're merely just living in Canada, providing their services to Canada, to the U.S. company for U.S. customers. That in itself is employment services in Canada. So it doesn't necessarily need to be tied to a Canadian operation per se for personal tax services to kick or personal tax to kick in on an individual. Right now we do have some leeway because of COVID, but the whole world is kind of opening up to people. I'm often seeing a lot more clients calling and asking, can my employee go work in Bermuda without any consequences? And what does that mean for me? And it does mean something for the businesses for sure.
Absolutely.
Yeah.
Absolutely.
So moving on, using of contractors in Canada. So we briefly talked about that when we were talking about the permanent establishment section. And does a contractor actually create a permanent establishment for an entity or a business in Canada? And the answer is, yeah, it certainly can. It really depends on what that contractor is doing. How dependent are they on you? So if they're only contracted to you, you're their only customer, you're doing all of their sales activity, merely just calling them a contractor versus an employee, it's likely that they could create that permanent establishment if they're closing the contracts, creating the sales, doing the business. It all, as we kind of said, it's a perception,
Sure.
right? So it's a very subjective description that you're looking at, and you look at it, and it's a perception that you are doing business in Canada by somebody who is dependent on you as a contractor. So by merely calling someone a contractor won't necessarily get you out of the permanent establishment in Canada. Employees are a little more black and white when you're looking at whether or not they create a permanent establishment. And you need to also be careful that these contractors aren't employees under the Canadian domestic law, because then you're going to be into the Canadian payroll tax obligation. So we quite often see businesses saying, well, I'll just hire them as a contractor because then I don't need to do payroll tax. And that again, under the law, that you can't really actually choose whether or not someone is a contractor or an employee. It is very defined. Yeah, it's very defined. If they're you're the only person paying them, you're providing their tools, you're telling them when they need to work, where they need to work, they're going to be considered an employee regardless what you call them, and be subjected to the payroll tax requirements. And we'll get a little bit more into the withholding tax a little bit further, but there is under the Income Tax Act the requirement to withhold if you have an employee or a contractor who has an establishment is providing services in Canada. So no matter what you call them, you're still going to be brought into that regime, even if you're not a Canadian business.
And I think the challenge, as you hear it, the challenge for a lot of American companies coming to Canada is you've got these withholding requirements for contractors and for employees. Mm-hmm. You often don't know that they're here, and you don't know until after the job's done that they were here. And so now you're kind of faced with, well, how do I deal with this in the past? Or even how do I make sure, my company, depending on the size of it, knows of these certain rules, that it's an education, it's being involved. We see this time and time again where jobs are halfway completed and they realize, we saw an expense report and someone's obviously been in Canada for a couple months. Like, what do we do?
That's right.
And we can help certainly in those situations, whether it's before, during, or after an assignment.
Well, that's right. And we do work with some companies where we have to do some voluntary disclosures, going back, helping them catch up on the possible payroll and doing equalizations with their employees in order to create it. Because the businesses aren't intending to put their employees out of pocket or into tax harm, if you will, right? By helping them with their business. So as Steve said, there is ways to kind of mitigate those situations, but it's definitely easier to stay on top of it ahead of time than afterwards. And the main thing is just to remember, as I said, contractors, even though you call them a contractor, they can still create the withholding obligations. They can create corporate income tax. They can create permanent establishments. They will trigger possibly an obligation in Canada, even if you call them a contractor. So it's important to not feel safe just because you're using that terminology when you use somebody.
So one of the ways we kind of look at this from an American perspective when they're coming to Canada is, yes, there's withholding taxes for contractors. In general terms, we'll talk a bit later about Regulation 105, whether it's withholding tax or 102. But there are waiver applications. You have the ability in certain circumstances, if that recipient is not going to be subject to income tax in Canada, either through domestic law here or through the treaty, you can apply in advance to Canada Revenue to effectively get a waiver to say, well, we don't have to withhold tax in those situations. And as you'll see later on, that can be a really important process to help with cash flow and help with some compliance. We talked a bit about the filing requirements that even, to get that answer, which is no Canadian tax or limited Canadian tax, you still have to, as an individual, file an income tax return, and that can often be to establish that you've made a connection under the treaty, to claim an exception, or as a contractor where there was tax withheld, you can then turn around and say, I wasn't here long enough, I didn't create a firm establishment myself, I want to get a refund of that 15%. And we see that from time to time where contractors in the U.S. will get a tax slip, it'll just say 15%, without knowing anything different, the thought might be, well, let's just claim a foreign tax credit on the U.S. tax return for that 15% and we'll be done with it. Your problem is twofold. One, Canada Revenue may or may not send you a letter saying, well, we see this slip. It should be accompanied with a tax return. That's not the final liability. On the other side, the U.S. may look at this and say, well, that's not a final liability either. It shouldn't be claimed as foreign tax credit because it's temporary withholding. So the correct answer is to actually go through the analysis to say, are they or are they not subject to paying tax? And do they get a foreign tax credit or not in the U.S.?
Yeah, both countries have the rule that you can't claim a voluntary tax credit. And if you choose just to claim it because you don't want to deal with the other country, it generally is denied by the country if they look at it saying that you voluntarily paid that. You shouldn't have actually paid it under the treaty. So, and that's not a good situation because you end up in a double tax. And then you now need to go back to the other country and say, oh, never mind, I shouldn't have paid that. Can I have my money back? Which is, again, it's always harder to kind of go after the fact and try and clean stuff up, right? So,
well, one of the other things that U.S. companies have to be aware of is when their employees come to Canada, if they are subject to Canadian income tax, those tax rates in Canada are generally going to be higher than U.S. tax rates. So it puts the employee at a bit of a disadvantage because if they just stayed in their home location and kept working, they would have been subject to lower taxes compared to taking this assignment in Canada, working here for a year, 2 years, whatever it is, and paying a lot more tax and not getting a full dollar for dollar credit in the U.S. They're worse off. So companies can do a variety of different things. They can do what's called an equalization calculation. What they basically do is they go to the employee and say, we recognize that you're going to pay more tax in Canada. We'll set it up so that you're paying the same amount of tax overall. So if you're paying more tax out of pocket, we'll effectively give you a bonus to cover all that.
That's right.
It's complicated because that bonus is taxable.
It's a very circular calculation.
It's like an infinite loop of tax, and so there's a mathematical form you can do. That's an expensive process. For example, if someone has a $10,000 differential And if they've got say a 50% tax liability in Canada, I'm doing some math here, you got to pay $20,000 to cover that $10,000. So that's an expensive process. Some companies won't do that. They'll instead either give the employee some choices to say, we'll give you an assignment bonus or a small per diem increase or whatever it is. And other companies will just say, you're on your own, we'll give you some tax advice, but you've got to deal with that. U.S. companies and U.S. employees coming to Canada just have to be aware that that's an issue, and it's got to be solved because, again, likely if they're subject to gain tax, it won't be fully creditable.
That's right.
On their U.S. personals.
That's right. It will carry forward though. So it's not a sense that you use it or lose it, but as Steve said, Canadian rates have typically always been higher than the U.S. So it's an infinite carry forward period of which will you ever get benefit from it? It's really unknown unless you have some type of income that's not going to be subject to tax in Canada, but can still be foreign tax.
It does become difficult to use if they're on short terms.
Right, exactly. Yeah, exactly. Just jumping gears a little bit more here over to sales taxes. We were going to talk about sales tax from a federal perspective. And so Canada generally, they have a threshold. So our threshold in Canada is about $30,000. And if you go over that, then you have to register as a Canadian registrant, charge GST for certain services and goods and so forth that you're providing in Canada. And they actually just changed it for online services as well. So places like Netflix or Prime, you will now notice you got an email from them saying we have to charge you GST now because they are now required to charge GST to Canadian consumers of digital products. Basically, the GST in Canada, although it's somewhat similar to the US in that you're charging it on goods and services, it's more like a value-added tax, I guess, if you will.
Yeah, you see the value-added taxes in Europe, in Australia.
Exactly.
You don't see them in the U.S.
No, I mean, it's called the goods and services tax, but it is more so as a value-added tax. And there's the federal one, and some of the provinces have their own. And the one biggest difference between the Canadian system and the U.S. system when you're looking at GST is you actually get to get credit for any GST you pay as a business if you're a registrant for GST. So let's say you collected $30,000 of GST on revenue, but you paid in your business to other people $10,000. Canada Revenue Agency, you get that difference. So you only actually have a net liability of $20,000 of GST. So it's a little bit of a gain. So it's not included in your expenses. It's a separate category that you would break out that GST what's called an ITC input tax credit, so that you can claim that on your GST to reduce your liability on what's that you've collected. Registration, now, it goes back to this, when do I register? GST does not look at the permanent establishment rules the same way that income tax. The income tax treaty is meant for income tax. So GST exposure can occur even if you do not have a permanent establishment in Canada. And that's a big thing to think about because some people assume I don't have a permanent establishment, I don't need to worry about sales tax, right?
It's a lot lower threshold, and we do see those situations. And when I see clients in that situation, I encourage them to say, the concern you should have with GST is that depending on the province you're conducting business in, it can be anywhere from 5% to as high as 15% in some of the provinces back east. That's a tax on you if you don't collect it. Mm-hmm. If you're working with a business client in Canada, that's not a cost to them for the same reasons Krista just explained, and that they get an input tax credit on their side. So you're just passing this thing on to the end consumer. But if you don't collect this and you work in Canada for a few years and you leave Canada and you get assessed later, Canada Revenue is going to you as the U.S. business to collect this tax. They're not going to your customer. That's on you to go to your customer.
Yeah. And good luck trying to go back to the customer and say, can you pay me 10% more, please? That's
always a challenge. I mean, the customer shouldn't care.
No, because they get it back.
But if there was a bad relationship,
or cash flow,
if there's cash flow issues, or heaven forbid your customer isn't there anymore, that tax is going to land on you. Yeah. So that's why we talk. If it's not handled properly, businesses can have a big GST exposure. The solution for that is to register for GST, to collect it, and to remit it.
That's right.
And sometimes that's a little bit more challenging when you're a branch. Because now what Canada does is they say, well, if you're not a resident of Canada, if you're collecting GST, we want a little more information from you. We want you to actually put up a bond a cash payment, if you will, of one half the GST you collect every year. So you got to do more work to register for GST and to actually collect it. But if you're a Canadian corporation, if you say, well, I don't want to go through that, I don't want to put up a bunch of money up front to this bond issue, maybe I'll just form a Canadian corporation, go back to that unlimited liability company. That's a Canadian resident.
Yeah.
You don't have to go through that process to register for GST. Sometimes that's the reason why you like it.
Exactly. And it really depends on what services you're doing. So there are companies that come up here that it could be exempt services. So you don't always want to blindly say, oh, I'm going to do business, so I should register for ITCs. Because if you're providing services to an exempt organization, then you're kind of stuck in the exempt loop, right? So it's not kind of a blanket answer, one fits all.
Well, one more thing on GST, there are some new rules that are coming in over the next month for non-resident businesses that are engaged in providing services in Canada. To the extent that you don't register for GST, you now have to go through a process where you have to ask your customer, are they an end user or a consumer versus a business? If your customer cannot confirm that they're a business and cannot confirm that they've got a GST number, you're actually supposed to collect GST and remit it.
Yeah.
Now, the difference between what we just talked about the full input tax credit and everything else is that under this new regime, you don't get income tax credits. You don't have to put up that performance bond, but you do have to ask that question of all your customers, either provide me a GST number or proof that you're a business, or I've got to charge GST. And so, these rules are supposed to kick in July 1st. I don't know that I've seen a lot of detail on how they're going to execute that, but it was announced last fall and it'll be confirmed.
Yeah.
I recognize here that we're on 41 minutes and we want to make sure we leave some time for questions.
We got a couple more slides here.
Okay.
Yeah.
So if GST and HST wasn't enough sales tax, we've got provincial sales tax at different levels in the country. More in Western Canada, in British Columbia, Manitoba, and Saskatchewan, we've got sales tax rates that are more like what they are in the US. They're more of a traditional charge the amount, remit the amount, you don't get a credit for everything else. If you're reselling goods that are being then sold as is on, you can get what's called a reseller permit to exempt yourself. But it's another level of taxation we've got to be aware of when you come to Canada, and that's generally a taxation on goods. It's a limited taxation on services. For example, in British Columbia, legal services are subject to the sales tax. But it can be applicable, again, even if there's no income tax and even if there's no other levies, personal tax.
And we briefly already touched on a lot of these withholding taxes, the contractors, employees, and royalties. There's, again, it really comes back to cash flow. And if you have the ability to apply for a waiver, you really should be taking those approaches. And it's important to know you have to do that in advance. So trying to come in after the fact and say, oh, no, forget it, I need a waiver, they're not really going to give you one. It's something you have to ask for in advance of the services being provided. So the Reg 105, that is a regulation under the Income Tax Act that says, if you are a contractor, whether it's an individual, a business, a partnership, any type of contractor that's coming in, providing services in Canada,
who's a non-resident?
Who's a non-resident of Canada, providing services in Canada, there's a 15% withholding that needs to be done on those services if there's no waiver in place.
And that applies to everyone paying services.
Everyone. So if it's a U.S. corporation
or a Canadian corporation
or a UK corporation or any type of corporation, bring someone into Canada or an individual or anybody that hires a contractor, non-resident contractor to do services in Canada, this 15% should be withheld if there's no waiver in place. So it's just important that you're asking the people when you're hiring them. You want to go through it's almost like a checklist, if you will. Are you resident of Canada? Okay, check. I can just treat you like a normal resident of Canada, providing a T4A and move on with our life. And we already talked quite extensively about the employees and Regulation 102 under the Income Tax Act. And if you have an non-resident employee providing services in Canada, under a permanent, and again, you can request waivers. The waivers exist. You don't have to withhold if you have no PE. They're not subject to income tax or subject to reduced income tax for whatever reason. You can request that waiver. But if you have a non-resident employee providing services in Canada and they are subjected to income tax and can't get the waiver, they're treated like pretty much any other employee for income tax purposes. Now, they may not necessarily be the same for Social Security because there are agreements in place for Social Security. Employment insurance, they're generally not subjected to if they're not a Canadian resident, but you have to go through that mechanism. And then royalties, equipment. People often think rent is tied to real property only, but equipment could be considered a royalty payment, and you have to withhold on that as well.
So in that case, if again, go back to that U.S. company that's got a branch, and either it's lending its equipment as part of that activity in Canada, there could be a 10% withholding tax on payments or even depreciation on the use of that equipment under Article 12.
That's right. Exactly.
So we have to see that. What can happen from time to time is if we're not mindful of the holdbacks that come on an installation, construction, any kind of project, and the withholding taxes, that one's profits can be tied up in those amounts that don't kind of come to the company until the very end of everything.
Right.
If someone has Regulation 105 tax withheld, let's say it the first half of the year, and if nothing's done about it, they may wait till 12 to 15 months the following year by the time they file their tax return, get Canada Revenue to assess it, before they can get that money back. And so the extent that we can get a waiver in advance, if it applies, you'd want to.
Yeah, absolutely.
Next slide.
This is
Is that the last slide?
That's the last slide. We're there.
Well, we definitely have time for questions. I want to thank Krista for stepping in at the 11th hour.
Oh, this one, dividends.
I'm sorry. We
That's okay. You haven't talked about dividends yet.
Okay.
One more.
Well, our very last slide, when we're talking a bit about repatriation of profits, we want to, one last portfolio next we want to talk about is dividends. And in particular, when we've got a U.S. owner that owns a Canadian corporation, there is a withholding tax on dividends paid out of profits from the Canadian corporation to the U.S. entity. That rate starts at 25%. That's our withholding rate under domestic law in Canada. We've got an income tax treaty with the U.S., as we've talked about, so that rate can get reduced down to 15%. If it's an individual owner of a Canadian company, it can get down to 5%. If it's a U.S. corporation that owns more than 10% of the shares of a Canadian corporation. One of the strategies we'll often use with unlimited liability companies, they have a very special treatment under the Canada-U.S. income tax treaty. They're considered a hybrid. A hybrid means that they're treated as one thing in one country and another thing in another country. And so they're a corporation in Canada, but it's a disregarded entity in the U.S. So as a result, the Canada-U.S. income tax treaty says that in general terms, we can't get to that 15 or 5% withholding tax rate because of this. And this rule's been around for a dozen years. There is a workaround. It's a bit of a complicated workaround where you actually go and you take the retained earnings or the profits from the company and you create what's called paid up capital. You establish that has a withholding tax. You then go and redeem the capital the next day. It's a strategy. It's called, it's a bit of a two-step strategy through legal resolutions that has been approved by Canada Revenue in about a dozen different scenarios. And so for an active business, that's a way we can continue to use the unlimited liability company as a subsidiary working in Canada and still get that lower withholding tax rate. And it's important because when you're going through the mathematics of saying I'm going to pay corporate income tax in Canada, I may pay withholding tax, we've got to make sure that we're going to be as efficient as possible to claim all this as a foreign tax credit in the U.S. So it's important to consider.
Yeah, I mean, it's been a theme in most of our webinars. If we can plan, there's usually ways to plan into the best tax result. And it's always easier to look at it in advance with the full spectrum.
Now we're done?
Now we are done. We have made it.
So again, thank you for your time today. We've left some time for questions and we're happy to answer those. If you have time, we'd love to have you complete our survey. You'll get that shortly. We'd love to know how we can improve these things. I think we're on about 5 or 6 now. If you have future topics you want to hear about, let us know. We're always trying to make these better and we want to keep doing this. So thank you for that. What questions do we have here?
asking questions is Shan, who's a manager within our team.
Yeah. Lou, I don't know if you can hear me there. Perfect.
Yeah. Yes, we got some questions here. So first question, if my employees start work in Canada in September 2020, and they are present in Canada for more than 182 days by April 2021, did my corporation's permanent establishment begin when my employees were in Canada for more than 182 days in April 2021, or when the 182 days began in September 2020?
So yeah, you would go back to September when the employee first started being in Canada. Now there is a little bit of leeway with the COVID rules currently, but under regular rules, if the employee is in Canada and they kind of broach that in their 183 days, from day one is when you created that permanent establishment. It looks backward. It doesn't go forward. So it's important. Generally, we're always telling people when they have employees who travel, they need a calendar, because it's the day your feet are on the soil that counts as a day. Even if you arrive at 11 p.m. at night, that's a day in the country, right? So it's important to track those things, because the worst case is, oh my goodness, they've created a permanent establishment. Now what do I do? Versus saying, okay, they're at 182 days, time to get out of Canada, and you can't go back for 6 months or whatever the case may be.
Absolutely.
Yeah.
And that voice you're hearing is Shan Liu. She's a tax manager in our Vancouver office. And I want to thank you for gathering the questions today, Shan. Are there other questions you've got there?
Yes. Next question. If I use my U.S. corporation to conduct business in Canada, am I subject to U.S. or Canadian tax on the earnings related to it?
So the question there goes back to that idea of a branch in Canada. So it's a U.S. corporation, and there's a variety of different types of corporations. There's what's called a C corporation, or a regular corporation. There's what's called a limited liability company. There's something called an S corporation, which is either one of those two making a special election. Let's just deal with as a regular C corporation. The idea there is that if that U.S. corporation creates a permanent establishment in Canada, if you remember, there's a bunch of different ways they could do that, whether they're here more than 12 months on an installation, software, or other kind of construction project, whether they have a fixed place of business here, whether they're employees, they're creating a firm establishment here.
Or a contractor.
Contractors, signing contracts. Then that activity is subject to Canadian income tax. And it's always a bit of a challenge for a branch or a U.S. corporation to say, well, what activity are you talking about? You know, I've got some revenue, I've got some costs here, I've got some back office costs, you know, how do I determine that? And that can be some of the downfall of using a U.S. corporation to work in Canada if you're going to have a firm establishment, because it's a bit of a mess trying to create, well, what is the true Canadian activity? In contrast, if you set up a Canadian corporation or a Canadian unlimited company, you know, with its own entity, with its own bank account, with its own activity, it's a lot easier to kind of draw a line saying, here are the activities that we're doing.
But I mean, when you do figure out what is the Canadian branch, only that portion is subjected to income tax in Canada.
Right.
The United States is still going to want you to report your worldwide income and your worldwide profits, and your worldwide expenses are on there, right? So it's the foreign tax credit mechanism in which you are able to not have that double tax. But it's important to note that even if you have a branch doing work in Canada and paying tax on that income in Canada, it's still reportable in the US as well. Yeah. Are there any more questions, Shan?
Yeah, we have a question on, could you please explain briefly on the COVID exceptions?
So the COVID exception, and this is just to be clear, this is CRA commentary, so it's not law. It's not written into the law. It's generally accepted. It's administrative. But generally under the COVID restrictions that they put in place, they basically said, and it was quite general in terms of what they said, but it was, if you've come to Canada or if you've left Canada and you couldn't travel because of travel restrictions that were in place, that in itself would not create residency or permanent establishment or subjected to payroll withholdings and so forth. And those are in effect, I think it was until December 2020,
It
right? I
covers
think.
kind of that March
Yeah.
15 to December 31.
Yeah, so they
2020.
kind of wiped that out now. 2021, anything people do are back to the normal rules, normal laws, normal treaty protection. But they did have something temporarily in place. And the travel restriction, they've kind of defined that, what they determined to be a travel restriction, because it might not be what we think that, you can't get an airplane ticket back, so you must be trapped, right? So you really kind of have to look through those rules to determine for 2020 whether or not it created a residency or a permanent establishment issue.
Okay, thanks for that. Next question. U.S. limited liability companies are common in the U.S. How is a U.S. LLC taxed when it does business in Canada?
So that's a great question. It's a little more challenging when you have a U.S. limited liability company doing business in Canada because not all of the mechanisms are available under the Canada-U.S. Income Tax Treaty. So it's from a Canadian perspective, it would be subject to income tax.
As a corporation.
As a corporation. The trick is then allocating all those activities, including any Canadian corporate tax payable, to the members of that LLC. Mm-hmm. It's not impossible. There's been some case law, in particular the TD Securities case, and some of the treaty changes that have helped, I'm going to call it northbound LLCs, to be a little more efficient than what we often see going the other way. A Canadian owning a U.S. LLC can often be very problematic. You've got some choices in there how to operate. Oftentimes we have the LLC make an S election, an election under the U.S. law to become an S corporation, which can make it a little more efficient. Oftentimes we'll have it form a Canadian subsidiary.
Or ULC.
Well, and the challenge with a ULC,
you have hybrid.
That's a real challenge with a hybrid owning a hybrid. We typically try to actually avoid that because the holding tax can shoot up to 25% and it becomes very difficult to manage.
Yeah.
Okay, great.
I think we got time for one more question, Chan, if you've got one.
So on the personal tax slides, you made a distinction between temporary and permanent in Canada. What is the distinction between the two?
I'm happy to answer this.
Sure.
So the distinction between temporarily working in Canada goes to a lot of the different exceptions we might have when it comes to whether we're subject to income tax for that individual, whether we're subject to withholding tax. There are waiver requirements and waiver potential applications of Canada Revenue when qualified employers have people that are in Canada less than 45 days or less than 90 days. You can actually get out of withholding tax on a temporary basis. On a temporary basis, you're not resident of Canada. So you may only be subject to income tax on, even if you don't get any of those exceptions, if you're only temporarily in Canada, you may only be subject to paying income tax on whatever you do in Canada. In contrast, if you're here permanently, and by that I'm implying that you've moved your family, you've moved yourself to Canada, you're living here now, you're no longer a resident of Canada, and you've, let's say, been relocated from the U.S. to Canada to run the division, run the business, own whatever it is, that has a lot more different implications because not only are you subject to paying income tax on that activity, you're subject to paying income tax on your worldwide income and worldwide assets. So it's a very different.
Mm-hmm. Yeah.
Excellent. Shan, thank you very much for those questions. And we want to thank everyone for their time today. We appreciate you joining us this morning. Again, we'd love to hear from you if you want to complete the survey. If you have other questions, feel free to reach out and contact us, and we'll see you on our next webinar.
And if there was a question that you asked today and we didn't get an opportunity, that will be shared with us, and we will follow up with you. Absolutely. As long as we know your name. When you ask the question, we'll be able to follow up with you to answer your question. And so thanks, everybody, and hope you have a wonderful day.
Thank you. Have a good morning.